My guest today is Kiran Telang, who is a certified financial planner and an author of at least a couple of books. Kiran, thank you so much for taking the time. I want to start with the most basic question. Why is it so important to understand risk and risk in its various facets? Could you describe that to us?
Well, thanks, Alex, for having me over in this show. As you described, the question that the investor asked in this morning, risk is something which is part of every person's life. There is no investment which is risk-free. The only thing is that the risks are of different types, and sometimes they're not so obvious. And we have been brought up to believe that, say, equity markets are risky, but the rest of the things are not. Unfortunately, that is not true. Even a simple product like a bank deposit has a certain amount of risk. The only thing is that the risk is very different than what you understand risk as. So when we are looking at personal finance perspective to risk, I would categorize it in three parts. The first would be the individual trait, that is, what is the risk tolerance of the person, and what is the risk capacity, and the third would be the risk required for that person to meet his life goals. So that is as far as the individual risk rate goes. And then when you further go into details, you can have asset class risks, and then further in that you have product risks. So these are different kind of risks. So, it does not help if you just look at one part of it. So like if you're asking whether a particular stock is safe or whether a particular mutual fund scheme is safe, so that is a very granular level of risk, but you have to look at the overarching risk in your personal portfolio. How does that risk translate into your personal goals? So that overall perspective is very important when you're talking about risk in the personal finance perspective.
So you start, Kiran, by talking about risk tolerance. And this is, I think, not necessarily only associated with financial products. I think to a certain extent, this is something that is important in all aspects, right? Some people choose to cross the road at the zebra crossing, other people take a chance and cross outside it, and that's taking a risk. So how does one understand risk tolerance, and how do you peg it when you're approaching personal finance?
See, as you mentioned, that risk tolerance by its nature, can be part of your entire life, not only investments, but it plays out very differently when you're talking about investments. Say for example, say a movie star. A movie star would, they are already into a risky, risky industry where their movies might run or not. So there is a high risk industry. So probably when they're investing, they would, prefer to go the lower risk way. So it plays differently with different people. When we are talking about identifying the risk tolerance, there are pretty much standardized tests, which are psychometric tests, which are available to gauge the risk tolerance of people. And inherently, these traits don't widely change over a long period of time. Though people could be more willing to take risks as they understand investments and different asset classes and different products, the inherent risk tolerance does not change much.
Yeah, absolutely. In fact, that was what I was going to ask you next. People often confuse risk tolerance and risk taking ability, but these are two very different things. And your risk taking ability would change depending on which stage of life you are, your income, your profession, whether your partner is working or not. So, how does one understand the risk taking capability? And if you're talking about a family or two earning members, is it that you have to consider both together, the risk taking capability?
So risk taking capacity, I would call it, is very different from your risk tolerance. Let us take an example of two 30-year-olds. So this one 30-year-old Mr. A is, say, a single earner, but he has no dependents. So in his case, his risk taking capacity is very high. Now, a similar way, there's another 30-year-old who has dependent parents, a homemaker spouse, and a kid. So in this case, the dependencies are very high. There is the person is a single earner. So the risk on his income and investments is much higher in that way. So if something goes wrong and whatever he has accumulated so far in terms of investment assets, if it is not available when it is required, it will be a very difficult time for the family. So even if this person has a high risk tolerance, he might not have the capacity to take that risk. Also, I would like to bring in another point here in terms of risk requirement. Like, for example, I said this person has a child. So now there would be future goals for this child, maybe 10, 15 years down the line for higher education. So in that scenario, the risk required for that particular goal could be higher. So you have a goal which is very distant and which could be a substantial amount that you're targeting. So in that scenario, you cannot do with low risk products like fixed deposits. You might need to look at products which involve equity, which will give you inflation beating returns over a longer period of time. So essentially, there would be three things: your risk tolerance, your risk capability, and your risk required. So an overall perspective from these three point of views should be considered. Likewise, I mean, we have this thumb rule which usually says, 100 minus age is what is the amount that you should be putting in growth assets, essentially equity. So this thumb rule is just that, it's a thumb rule. It might not stand. I mean, when you're looking at a wider framework in terms of, risk requirement, like I spoke about this 30-year-old with a family, this thumb rule would not stand. A similar, maybe a 60-year-old could be in a similar position. So a 60-year-old who has substantial wealth and has no dependents can take a higher amount of risk. It does not necessarily mean just because he or she is 60 he cannot take more risk in his portfolio. So it all depends on the life circumstances, on the assets that you've built so far, what are your dependencies, whether you have any loans running. So all these factors define how much capacity you have to take the risk.
So, and you've given us this entire grid in which you've described at the various life stages and you said this is a thumb rule, these are indicative, and each person's finances are different, and that's why they call it, Kiran, personal finances, right? Because while your goal may be the same, you might all be working towards a retirement or maybe buying a house. Your context is different always, which is why it's so important to understand your own risk. But what do you do if there is a gap, like you just pointed out? If somebody's risk taking or risk tolerance is low and the requirement to take risk is relatively higher, how does one bridge that gap? Is it important to therefore club your goal setting with an understanding of risk?
Absolutely. I mean, they go hand in hand. So when you're, setting the goals, you define the tenure of the goal. So if somebody has a goal 3 years down the line, obviously the risk capacity is much lower. So even if the person is a very high risk tolerant person, he will not be able to, take risk for that 3-year period. So he should go towards less volatile assets. Likewise, as you said, if somebody is very low on risk tolerance and the requirement for the goal achievement is much higher, they will need to understand that that amount of risk needs to be taken, or else they will have to compromise on the goal amount. So if you have a target of, say, achieving a figure like 1 crore in, say, 10 years time, and you're not willing to go beyond traditional investments like fixed deposits or which are less volatile, basically debt instruments, in that scenario either you compromise on your goal amount or then you increase your savings. So there could also be a case where the income is very high, so it is possible that the person can invest much higher amount. So that is possible. So there are only these two routes: either you save more or you compromise on your goal. There is no third way out of this.
Understood. Now, for the benefit of the people tuning in, Kiran, it's also true that not everybody has the ability to go in for these psychometric tests or to analyze what their risk tolerance level would be. How do they then approach that if they don't have the access to that? Do they still then, is it better to at least follow a thumb rule rather than not doing anything at all?
I would say rather than following a thumb rule, if you look at your own circumstances, you will be able to figure out yourself, to what extent you should be taking the risk. It's as simple as looking at what your goals are. So like I was talking about a child's education, which could be 10 or 15 years down the line. So in that scenario, your capacity to take the risk for that particular goal is very high. Vis-a-vis for somebody whose child is going to higher education in another 3 years time, so there the capacity to take risk is much lower. So when you have a longer tenure, you peg your investments towards assets which are inflation beating but which could be volatile, like equity. Whereas if you have shorter term goals, you should peg your investments to debt investments, which could be maybe the returns will not be very high, but you are kind of keeping your assets in a less volatile area. So that way is a broad manner in which you can figure out what your risk capacity is and look at it in a very commonsensical way.
So, in a sense, what you're suggesting is that you put each goal through this matrix that you have suggested. These three parameters: your risk tolerance, your risk-taking ability, and the third one would be the risk requirement for that particular goal. And you will have essentially an answer that you can work out for each of the goals that you set. Is that right?
Yes, broadly, that is the simplest way to look at this entire thing.
Okay, so we are going to have, Kiran, a little bit more of a conversation on the risk associated with mutual funds, because I think the regulator has done something incredible in terms of this riskometer that is a very clear indicator of the risk associated with investing in mutual fund schemes. We're going to be talking about this after a very short break. Do stay with us, and viewers, do stay tuned. Lots more coming up in just a short while.